The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. And I know this isn't the commodity hour, but the thing that's getting most of the play today is the gold and silver. You know, they're getting hammered again. Gold down another $100. This usually results that somebody with a very, very large position is getting hammered and is not answering a margin call. That is usually the case. Friday's action in the last 30 minutes, most people were already gone, and gold dropped another $30 very, very quickly. I'll go through what gold did last night because it's very, very interesting if you look at pattern recognition. But the one I wanted to start with was silver, because we had that double bottom form in the end of 2011, then we had the triple bottom form in June, and now we have broken all of that, and we've gone down to the 1.27 expansion at the 2330 level. And so there's a 200-day cycle due sometime around here, so I know it's very difficult to, put your buying shoes on when you're, ready to buy some gold or silver. But if you wanted to buy, some silver dollars or something today, I think that's they might go to 17. It certainly could. But, this is a place where we should get a very good bounce. We've had one of the, most severe drop that we've had since the top was made in April of 2011, where we dropped, well over $17 an ounce. And this one, we've dropped $12 an ounce, which is 0.618 of that. So we should be in an area where we should have some, at least some type of a bounce, from some area. Now, the next one that I wanted to put into Tiger TV, I think is very important. I posted this earlier in the show, and that is the long-term gold weekly, and that showed the price coming in at $13.64. That was after 200 days, two 100-day down moves per ounce, and that hit the 61% retracement, and it hit the 38% retracement, and hit the 50% retracement, all at the same time. So this should be a pretty good bottom, in the gold market. It has all the characteristics that you need if you were reversing it and looking on the upside, on an upside explosion. You have the exact same things happening in a mirror image on the way down here, and it's stopping exactly at these numbers. Now, last week I thought we could possibly make the 440 level in gold. We were trading at 1565 at that time, and we went through that like it didn't even exist. And, that's pretty much, what we're looking at. As far as, you're hearing things about the COMEX exchange and all of the other stuff that's, going on. The problem is you can't believe any of that because they lie to you. I mean, we already learned this from PFG Best. We learned it from Goldman Sachs. We learned it from the U.S. Treasury. We learned it from Bernanke. I mean, it's you don't know what's going to happen. That's what the old adage, it used to be the man who owns the gold makes the rules. Today that's not working. But that doesn't mean that that this is still a bull market in gold. This is the first major on a weekly basis ABCD correction that we've had since 2008. The first one. Go back and look. You'll find we didn't even have one, back in 2012. It didn't make it. It just stopped at the 61% retracement. So this is where it's going to hold, either right here in this 1560 level, or it'll go all the way down into the high 12s or even $1,000 an ounce. Remember that the old high that we had back in 1980 was at $800 an ounce. So that's another thing to keep in mind. But what I wanted to show you folks, I mean, if you like looking at gold, I just want to show you what happened last night, because I happened to be involved in this, and I just wanted to let you see what's really happening. And if you like these little ABCD patterns that we all talk about, thanks to H.M. Gartley, you'll see the that the market opened a little bit higher Sunday night on the 14th of April. We rallied about $17 or $18, and then we broke very badly down to the 14.12 area. Then we rallied to a 50% retracement. Then we went down and made a perfect ABCD pattern at the 13.82 level. We rallied almost exactly 61%, another $45 rally up to the 61% retracement, and then down one more time, making another ABCD pattern at the 13.55 level, which is that long-term weekly ABCD that we looked at. So what we have forming here is we have this nice three-drive to a bottom pattern on the 5-minute chart coming in at the same time as all the weeklies that we have looking at it. So, this might not be the place to buy gold, but you certainly don't have to risk very much at this particular point. And I know you might think I'm a crazy man. Well, most of you do anyway, but that doesn't make any difference. The numbers speak for themselves. You don't have to risk very much down at the 1560 level versus 1360 level as opposed to 1575. Remember, folks, gold was telling us that it did not want to go higher a long time ago. This is not anything new. The rallies that we had during the Cyprus thing was absolutely, it was horrible, and that should have had a spike of at least $80 or $100. The most we could move was around $40 or $50 during that move, and all the tops that we had in gold were lower. All the tops that we had in silver were lower. I mean, it's been in a downtrend, for a considerable length of time, and that it's broken so many areas of support that it's really difficult to try to be bullish on this stuff because it's just had such a bearish bias all the way down. And now we're at a point where the whole world is bearish, and you're going to be looking at something that is a little more sinister possibly. And this thing could just literally melt down. That's why you've got to put a stop in. People think that it had a bottom at 16, 15, 14. Even 13. You don't know. That's why you've got to. It's the business of risk management, and that's what you're trying to do when you're looking at these particular ones. Now, I want to give you a little update on the XAU because we were very bullish this a few weeks ago when we made the 61% retracement at the 127 level. We got a rally of about 2 weeks. And then we went below it, and, that day we went below it, this old cowboy said, I was wrong, and I ain't long. And so this thing is headed lower. The 786 on this comes in at 100, and we're trading at 107 now. The futures have made this retracement number, whereas the XAU, really hasn't. But this has been a very bearish market. Especially since we broke the 618. But now is the time where we probably will get a little bit of a snapback rally in gold and silver just based on some of these numbers if they hold. And if they don't hold, then there's major problems. So that's the real key, to watch, because when they don't hold these numbers, they really do fail. If you believe in pattern recognition and you believe in Fibonacci numbers, take a look at the very first chart that I posted in the Tiger TV today, and just look at those beautiful retracements that we had on the way down in silver at 50% to the exact penny, 61% to the exact penny, and 786 to the exact penny. We had minor rallies off of all those, but that just shows you the harmony that's there in the markets, that if you'll look for it, you'll be able to see it. And the expansion that we made today down at the 2330 level is the 1.27 expansion of all those lows that came in off the double bottoms and triple bottoms. That's why this level is so very important. We haven't had a move down in gold on a percentage basis of this magnitude since 1980, after the market topped on January 20th of 1980. It's been a long time since we've had percentage moves in gold that have come in too much. And when it starts breaking these numbers, it just it really is just being pulled down by the larger set of numbers. That's the bottom line of what you're looking at. So To be safe, it's better to wait a few days because, believe me, this market is not going to turn and go straight up from here. You're going to have a lot of, backing and filling and churning and stuff. You'll probably get one nice 61% retracement, maybe even with a ABCD Gartley format to give you a low-risk entry into either some gold stocks, or the silver stocks. I spent a lot of time last night looking at these markets because you don't see this stuff very often. And so when it happens, you've got to be there to watch it, and that's why I followed it most of the night, watching the ABCD form in the gold market, and the fact that it was acting so much with so much harmony. Both of those rallies that we had in the middle of the night were exactly equal within $2, and then of course we had the ABCD formations, all three of them forming that three drive to a bottom pattern down at the 13. Gosh, it's dropped so fast I forget the first two digits at the 1360 level, and we haven't been at 1360 in a long time. But this is the first major ABCD we've had in gold on a weekly basis since 2008. We got our friend from John in Philadelphia. John, are you there?
Hey, Larry, congratulations for working all night and staying up in the morning.
I had no choice.
No, nor did I, sir. Hey,
Yeah.
Larry, tell us, you've been in contact with lots of people in the past 12 hours. What words are you hearing about brokerages being impacted by COMEX-related losses?
Well, I haven't heard much of that at all. The only thing that I have heard is that they one large firm, I don't know whether it was J.P. Morgan or Goldman Sachs or whoever it was, but one large firm, it was probably Paulson because he holds things for a long time, and when he gets in trouble, he lost $300 million on Friday, and if you add what he lost today, he lost pretty close to $700 million to maybe even $1 billion, which would be 25% of what his fund would be worth. And if he has to liquidate, that might have caused some of this. But frankly, John, I really don't care. I just look at those numbers, and that's all that means anything to me because I know how much these people lie to you. They that's their job. Their job is to give you misinformation, and they do a really superior job at it.
You are absolutely right on that, and I can't agree with you more on focusing on the price action itself.
Have you heard of anything? Because I know you have your ear to the ground as much as I do. So what have you heard?
Yeah, the answer is I have heard nothing. Of course, the operative phrase, I'll repeat, you just said, is beware of what people do say on account of either misinformation or outright lies. But what I can share with you and your listeners, I always find it helpful, Larry, now that the derivatives, the COMEX, the futures exchange clearinghouses are held by publicly held. You know what?
Hey, John, we got to take a break. Stay with us, okay?
I will, yes.
Yeah.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back, and we have our friend John from Philadelphia online. John, you still there?
I am, Larry.
And we were talking about, the things that are going on in the gold market and the fact that we've had this huge break, and if there are any of the firms, in trouble. I haven't, the person, my go-to guy with this is Rich Anderson, because he knows more than anybody else out there, because he deals with so many of the larger firms, and I don't know if you folks know this or not, but he's actually the broker to several of the market wizards and some of the really heavy hitters in our business, and Rich said there didn't seem to be any problems, with this. The firms are very quick, of course, to react to these margin calls, especially when, gold is dropping. I think the margin on gold is about $8,000 or $10,000 a contract, so only large accounts are going to be trading it, and usually the firms will not let a person that's on margin call for 1 day give them very much leeway unless it's a preferred customer.
Indeed.
So I think they'll try to protect the. Hey, but listen, after what's happened over the past few years with Bear Stearns, Lehman Brothers, I don't trust any of them. I really don't. They have to prove it to me.
Larry, I agree. Throw MF Global into the mix as well. What I would just like to add to your discussion there, Larry, is the idea that with these massive declines in silver and gold, there are traders who've just lost fortunes. We're talking hundreds of millions, if not billions of dollars. And in the event that a customer and the broker of the customer can't make good, on those losses, therein comes the function of the clearinghouse, who in fact is obligated to make good in the event of a failed customer trade that doesn't pony up. And in this event here, the major U.S. futures exchanges are all owned by either CME Group or Intercontinental Exchange, ticker symbol ICE. And what I'm watching today, just for integrity of firms that I deal with, is watching the stock action of CME and ICE, because insiders, if there are massive losses building up inside of the clearing houses, insiders will know to sell those stocks. So that's a clue that I'm looking for. Just wanted to share that with you.
That's a great clue to watch those ones that are listed. You know, you'd be watching things like, you know, J.P. Morgan and Goldman Sachs and Morgan Stanley, and then also CME, especially the CME. The problem we have with the CME, John, is that they were no help when MF Global. They didn't stand behind it like they should have. You remember how many times I've been on this the commodity show, and I told the folks that the levels of important. It's the CME itself for protection first. Second is the CME clearing members. Third, it's the CME members. And then down the couple lines down from the next levels are the customers. We're the last ones in the mode of protection, so they should have been, you know, standing in front of that ahead of time with MF Global, but they didn't, and that happened very quickly. You know, that stock went to zero in a matter of a few days, and you know, this is why you must protect yourself at all times in these markets. I mean, there's just you know, no other way to look at it.
And Larry, I would just add to that the importance of diversifying. Every customer diversify his futures brokerage business. I personally deal with never less than 3 brokerages with capital equally split in the event that one croaks on me.
Well, I'm aware of that. I've been there, done that one, my friend. So that is the smart thing to do for sure.
Very good. Well, listen, Larry, thanks so much. We'll be watching those patterns, sir.
Okay, thanks for your input, John. I always enjoy it. Okay, folks, we're going to take a quick look here at Apple, and then when we come back from the break, we'll take a look at the stock market, you know, where we're looking, you know, things there. But the Apple, we've been waiting to see this thing get to around $400 to $394 a share. We're only 4% away now. We're testing the old low at $419 very quickly, and I think we'll get to that level, you know, relatively shortly, around that it should be a lot of news if it breaks $400 a share. But here again, this will be the first time in several years where Apple has made a major A, B, C, D correction. So this is where we want to be looking at Apple. We've been patient. So when the 400 calls now are selling for 34, so if we can get it down another 25 to 30 points, if we can get those calls down to about $10 to $12, so your risk would be $1,000 to $1,200, then we'd be able to have something to hang our hat on, because the rally should be at least $100 a share. We've got to take a break, folks. 877-927-6648. 6684.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, folks, we're back, and I wanted to put one more chart of Apple in the mix here for TFNN listeners. This is a long-term chart going back to 2005, and it shows that, Apple has had 4 major ABCD corrections during that time. The first one was in 2006. The next one was during the financial crisis of 2009. And then we had another one that occurred in July of 2011. And now we have the largest correction of the group. That's the ABCD pattern, is finishing up now around $394 a share if our analysis is going to be correct. And as we get closer to that price, we'll be watching that June 400 call and also the June 450 call to see which one we can enter without risking too much. We'll also look at the stock too, but mainly from a technical basis to show you how these ABCD patterns work. I mean, it's why the market goes up and down, all the time. So that's all we're watching. So we need to keep a close eye on Apple because it's a very, very popular stock, and it also is something that everybody has one except me, I guess. But they're very, very popular, very, very popular. Very, very popular products. And what I'm trying to do is to get ready to put another chart up and get an idea of some of the things that we're looking at in the market. The next chart that I want to put up is showing the relationship that we have been talking about several times That is the relationship between the stock market and the T-bond market, and you'll notice that the yields, have been dropping, which is what we wanted to see because we think we're going to get a short signal very shortly in the Treasury bond market, and that'll give us a pretty good chance to, get short the market. The next one that I wanted to put in, this is a different way of looking what we've talked about several times, and that is the optimism that is here. Right now in the market, we're at the same levels that we were, back in 06 as far as the people that are very, very bullish. We posted the things from the Wall Street Journal where mom and pop were heavily, in the stock market, and, I think that's the wrong place to be at the present time. But this chart just shows you that the optimism at the CBOE when they're working with puts and calls has been as high as it's been since 2006. It's even taken out the high from 2007. So the rosy picture that they're trying to print to us on the stock market may or may not be the case. Now, the next one is something that we've talked about for weeks here. I mean, this is the relationship between commodities and what's happening in the stock market. And if you'll take a look at this chart in Tiger TV, you'll notice that by the way, this comes from Zero Hedge. They publish some really good charts, and they're very easy to read, and so I use them, to give you an idea of what's happening. We posted charts like this from my own system, but this was just another way of looking at it. It shows you the tremendous divergence that we've had since January 1st. This first quarter, we've never experienced anything where commodity prices have collapsed and stock prices have gone up. In 2007, the stock market started down first, followed by the big collapse in the commodity market, but this time there's been a huge divergence. Everybody is blaming this on QE2 or QE1 or whatever the number is right now, but frankly, I don't think it makes any difference. The fact that it's happening is the main thing to look at, because it's a huge divergence. It means a great deal because these companies, they buy commodities to make products, and that's really what we're looking at. And you have to be incredibly aware of what's happening to these things, because they're just really very, very very, very ominous. And in particular, the one I wanted to bring up, and we've talked about this several times because of the rising wedge pattern that we had way back in July, and then we had another one in January where copper started to break down in January, whereas stocks continue to go higher for 4 months now, January, February, March, and April, and copper has been going straight down for 4 months. And if you go back and look what happened in 2011, the same thing occurred. In July of that year, copper broke well over $1.40 a pound, and we've already broken 60 cents of that. So we still have another 60 or 80 cents to go to copper just to reach what it did in the 2006 or 2011 area. So the commodities are telling us that this move in the stock market is not correct. The bond market is warning us that there's something not right that is going on in the bond market for sure. So we have to keep all of these things in mind, when we're watching the markets, because it's very important, to not just have a broad brush approach, but to get an idea that these things they mean a great deal. So that's what I think is important. We're having big drops on the world market. I focused a couple weeks ago, the newsletter, the fact that the rest of the world was not participating in the markets, and they were breaking down a great deal, and that also is not a very good sign. The one interesting one that I was bringing up that I had got ready for the newsletter that I thought everybody would be interested in, is if I can just get this thing to come up. Hold on one second here. Was the chart that I posted earlier, and I did these on Saturday. So I didn't have any idea what was going to happen. I knew the market had broken really bad, and I said, if the market can break $100 in one day, it can certainly break $100 in the next day. And that's exactly what's happened today. We got more selling, and it's probably related to margin call selling. That's my guess. I have not heard of anything related to this as of yet, but if I do, I'll certainly bring it on to your attention, and then if things get really nasty, we'll have oh dear, I won't be on the show Thursday. I have a family thing that I have to do. I have to let TFNN know that I had this written down, but I'll be on the show Wednesday. But Thursday they'll have to have someone set in for me because I have a family thing that I really need to do. But all of these things that we're looking at, gold, silver, platinum, all of the commodities are breaking down badly, and this is not a good sign, folks. This is not what they're supposed to do in the sign of a good in a good market. That's not that's not what really should happen. Now, the whole theory of economic theory is supply demand, and if you have really good demand for commodities and your economy is booming, then these commodities should be going up. Now, someone did propose a theory that might be correct, that one of the reasons why the stock market is so bullish right now, or has been going up for so long, is the fact that these commodities are lower and that their cost of production and everything is going to be even better, and so they will have a greater, even greater profits. So that's also, the possibility. That's when you start to thinking about the trades, and I always like the title of one of my books is Trade What You See, Not What You Think. And the other book that I wrote, it's not what you think, it's how you think. And that's the real thing, is to just try not to let the biases of the market get in to what you're thinking about, because when you're hearing things in the news, you can't really believe them if you don't see it on the charts, because if prices are going up, there's more buyers. If prices are going up, there's more sellers. How many gold bugs are out there that are still looking for $2,500 per ounce in gold? And they might be right. They're not going to be right, right now, but they might be right on a long-term basis. But are you willing to watch gold drop $225 in 2 days? No, I don't think so. That's not good. That's what we try to do, is to, find a place where you can enter the market and then not risk very much, put a stop in, and then see if it's going to work. That's the bottom line of what, trading theory is all about. There's nothing, really, amazing about it. Now, we had something interesting happen in the euro on Friday. I will switch over to the dollar index and stuff, and you'll see that the euro stopped exactly at the 382 at the 31.10 level, and I think we're getting ready to come down in the euro. We had a nice 10-day rally in that. That means that our dollar index is probably going to stay up around this level for a few more days, and then we'll see what the next leg is going to be on that. But there's no panic in any of the currencies. There's no panic in the stock market. There's no panic in the bond market. None of these things show any sign. That doesn't mean that can't happen, but right now there doesn't appear to be, anything really, really dramatic happening, anywhere, at least where I can see anything happening. That's for sure. Now, the one that I always bring this up because I think it is very important, and that is this chart on the S&P cash and how it relates to the yield on the 30-year bond. And if you'll notice that spread between the stocks going up and the bonds going up at the same time, that doesn't happen very often, folks. And so that means the yield. People are really, really searching for yield. And what they're doing, they're even buying junk. We've mentioned this before. American Airlines came out with, and they're in bankruptcy, by the way, and they came out with bonds that they were able to sell at 4.75%. That's only 2% higher than the 30-year bond, and this is a company that's in bankruptcy. So, that's another reason where I think that we have a big problem looming. In Bernard Baruch's book, his autobiography that was entitled My Own Story, one of the things that he said was that the market exists to bring as many buyers into the market at the wrong time as possibly that you possibly can, and then people will think they're buying value, all the way down. And this is what happens to these things. They run them way up in price, and then all of a sudden they run them. The prices collapse, and then people get hurt badly. Whether it's real estate, tulip bubbles, Florida real estate, they all end the same way. It's just a question of not if, it's a question of when. And we're waiting to see, how high these bonds are going to get, to see if we're going to be able to make this move, the way we want to see it. I'm going to spend a couple of minutes here before we take the next break on the bond market, because we've had a real interesting situation happen over the last few days. One of them we talked about last week on the Commodity Show, and that's where we completed a perfect ABCD in Treasury bonds down at the 145 level, and now we've rallied a couple of $1,000 up into the 147 level. And if you'll notice, last night we had a very small ABCD correction of about $600, and then we've had a move up, and it looks like the bonds are heading up to the 150 level, and if the S&P starts to break, there'll be a flight to quality most probably, and that could get the bonds up to that level that we want to see reached, and then that will be what I think will be the last hurrah, and then we'll go from that level if that's the case. Someone asked a question about Apple. Am I sure that it's going to stop at $13.94? Absolutely not. I don't know that, and no one else does either. All I know is we've been looking at I've got gold on my mind. We've been looking at $394 a share in Apple for well over 2.5 months now, waiting for it to get there. The timing window that we're looking at was from April the 8th to April 19th. April 19th will be Friday, so we'll be looking at around the 22nd. April 22nd is looking, the day that we'll probably be, they shouldn't be buying it on a Friday. We'll probably be looking at it on the 22nd of April for Apple. But the price level is $394 a share. If it gets there between, Thursday and Friday when I'm not on the air, I would really, have you take a look. If the Apple hits $394, look at the June 450 call that was selling for around $16 or $18 today, or the 420 or the 400 call that was selling for $34. If you could get that 400 call for around $12 with the stock at 94, I think that would be pretty good value, because you get to hold it for you get to hold it for the rest of April, May, and 3 weeks in June, so you've got 6 weeks to work with it, and the most you're going to lose on it would be your total premium. And if we go below $394, we could probably reduce the risk, even more. But the ideal situation that it takes its time and to get down there these last few points, and get the one thing we don't want to have happen to Apple is to get to close to $394 and then it gap $40 lower. That's no good. That's why you want to look at it a day at a time, because this is one of the reasons why when these numbers break, you've got to be really, really careful to protect your backside, because if you don't, you're going to be looking at working at McDonald's or some other lucrative position. So we'll see how Apple's going to act. Anyway, the Treasury bonds still look okay. From a fact that they're rallying a little bit. We're up at that 61% retracement again, and I think that we have a potential to make at least the 786, which is another 2 points away, and that shouldn't be too hard to do, especially if we get a sell-off in the stock market. The key number to watch in stocks today, I'll switch over to the S&P here, because I was watching it most of the evening also because of the action that we've been having. And if you'll give me a second, I will put up the chart that I've been watching for quite some time.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I've posted in the 15-minute chart of the E-mini S&P that goes back to April the 5th, where we had the big run-up to 1593, and now what we're doing is we're making we've gone through the 50% retracement. We're heading towards the 61% retracement down at that 1555 level. We're getting there very quickly. So if we go below 1550 today, this is going to ring some bells on Wall Street. It will really do some serious damage to charts, especially it being a Monday. They don't have the most of these hedge funds and mutual funds. They do their work over the weekend, and then they act on Monday, and I doubt if many of them were in a sell mode coming in to today because the market had held up so well. But right now it's breaking down into this level of looks like it's going to make the 1555 level, and we'll see if that's going to be the case. It's still early in the day. We've got 3 hours to go, but it looks like it wants to get to that level without too much trouble. Now, someone asked a question about the gold position. We took a nibble at gold at the 15. Excuse me. These numbers, they're jumping around so fast. I can't get them. They're all in the same area. we had that 3-drive pattern form in the gold, and what we're happening now in the gold is the relationship that I mentioned to you before is to wait for a little retracement. In the gold coming back to the 61% retracement would be the safer trade, but that's still higher than what we paid for it. But the most you risk on a trade like this would be $10. So buying it at the 1360 level, you put your stop at I got to remember now, $13.50, $10, and then you would be protecting yourself, because when the rallies come, and they will, when the selling is finally finished, you'll have a big move. But this pattern in gold is the one that we look for. It's Mother, God, and Country. You got your 3-drive pattern on the 5-minute. You've got the daily pattern finishing at 1360. The weeklies finishing at 1360. Everything is there. Whether it works or not, I don't know. But you're trading a contract that's worth $136,000, and you're only risking $1,000. That's a pretty good risk-reward ratio, because your first profit on this would be $70 a share. So that's a tremendous 7,000 possible win to a 1,000 possible loss. But this is not for the faint of heart on a day like today. You really need to know a little bit about what you're doing, and I certainly qualify on the little bit part, because sometimes I look in my mirror and say, what are you doing? But this is what we'll take a look at. Anyway, the S&P should have some support at that 1555 level, and if it does not, if it closes below 1550, this is going to signal a very major correction. And the reason why is you'll be retracing more than 78% of the move that we started on April the 5th, 10 days ago. In just a matter of a few hours, you've retraced more than 78% of that if we go below 1550. That's going to tell you that you're going to have a pretty substantial break in the S&P. That is what I would be suggesting. And, we'll know more about this, as we go to the through the week and get, more idea of what's happening and see which of these patterns work and which ones don't. But that's pretty much it. I mean, we're getting ready to wind it up. So keep an eye on the Treasury bonds. We could get up to that 150 level. And right now they're just hovering at the 61% retracement. We know the numbers to look at in the gold, and that's it. Live every day in an attitude of gratitude, and may God bless each and every one of you.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.